The stock market is currently up over 14% in the past year, but certain stocks have far outperformed that. My personal stock portfolio is up over $18,000 this year, and that portfolio is entirely made up of individual stocks that I picked. And in this video, I'm going to reveal my entire $160,000 stock portfolio and what's in it. Hey everyone, and welcome to FinTech. And in this video, I'm going to show you exactly what stocks I hold in my stock portfolio, how much is in each of my different positions, and finally, why I invest in each individual company. At the end of the video, I'll also talk about any trades that I'm making in the companies that I currently hold. I don't see too many people revealing their exact stock portfolios on YouTube, and I figure since I make videos talking about stocks and whether or not I like the companies, I figured it would only be fair that I show what trades I've actually made. My goal is to be as transparent as possible, and the point of this video isn't to say, oh, look at me, I made a bunch of money. It's to, one, provide accountability and to actually show that I put my money where my mouth is, and two, to show that while it is risky, picking individual stocks can outperform the indexes both on a short-term and on a long-term timeline. But enough intro, let's pull up my brokerage account and start walking through the stocks that I hold in my portfolio. So right off the bat, we have my Charles Schwab portfolio, which is my taxable brokerage account, and I'll put it up on the screen so you guys can see. In this account, you can see that my personal value is just over $160,000. Just in the last day, it's increased by $750, and overall for the year, it's increased by $18,103.69, which is a 12.5% increase. Now, one of the downfalls of Charles Schwab is that when you add money into the account, it counts that as a gain, so I have added some money to this account, so this isn't an entirely accurate portrayal of how my actual stocks have performed, but we'll look at the individual positions to see that. So real quick, let's just look at this chart here, which kind of shows the portfolio performance over the past year. You can see that it's been pretty volatile. It started out at around $140,000, slowly increased up through February where it hit its all-time high for the year at $168,000, after which it crashed pretty dramatically through March, and then it recovered over the course of April into May, after which it crashed again in the early beginning of May to its all-time low of, it looks like, around $133,000. After that, it then recovered again over the past month, and now it's back up to $162,000. So it's obviously been a year full of ups and downs for me. And then if I also go and look at my 2-year view, it looks a little bit better. You can see that I'm up over $125,000 over that time period, and that's because 2020 was kind of the ultimate breakout year for the types of stocks I invest in, which tend to be cloud high growth stocks. But looking at this overall view can only give you so much information, so let's now dive into the individual stock positions that I hold across my brokerage accounts. Now, one of the nice things about Charles Schwab is if I scroll down here, it has a list of all the different positions that I hold, and I can combine it between my different accounts. So even though I hold some stocks in Vanguard, some stocks in Charles Schwab, this will add them all up for me right here. So the first position that's going to show up here is CrowdStrike, and that's because that's my largest position overall. I own 210 shares of CrowdStrike with a market valuation of over $45,000 invested in just this one stock. That's about 27% of my overall stock portfolio. And then if I keep on going down this line, you can see here my cost basis is $11,882. So that's the amount of money that I've actually put into this company actively. And then next to that, you can see the total gain in this stock is over $33,000. So the main reason this is such a large position is just because it's grown into a large position over time. I really didn't invest that large of a percentage of my portfolio into it. The main reason that I invest in CrowdStrike is because it's, in my opinion, the best security company in the world, and it's the best positioned company to take advantage of companies moving to the cloud. Over the past year, a huge amount of companies have started moving their on-premise infrastructure into a public cloud, hosted by companies like AWS, Microsoft Azure, and GCP. When those companies did that, they need a security solution that can scale into the cloud just as quickly as they can. And while some other security companies that have existed in the past have started to kind of build out into this area, CrowdStrike is the only cloud-native security company that's really performing at this kind of scale. They're also growing at over 70% year over year, so this is one of my highest conviction positions, and there's a reason that it's gone up $33,000 off of an $11,000 investment. The next position that I have is Datadog. Datadog I own 385 shares of at a total market cap of $35,000. This stock had a cost basis of $22,500, roughly $22,800, and it's had a gain of $12,200. So respectable, but not nearly as much as CrowdStrike. Datadog's goal is to basically capture all the different data that a company needs to operate and put it under a single pane of glass. So that would be their applications, their infrastructure, their security, everything that they could possibly need in terms of data. Datadog wants to become the dashboard for that for companies. Now this is both kind of a macro play as well as just a good company, because there's obviously going to be a huge proliferation in data as more companies move into digitization, and there's new IoT devices. We're going to have 5G technology, which will produce way more data, and companies just moving to the cloud start to realize that all this data that they're producing can have analytics run on it that actually creates value for the company. The other side of this is that Datadog itself is just a really good company. People seem to really like their products, and in general, customers who spend $1 on their platform 1 year are going to spend over $1.30 on their platform next year, for example. Also, Datadog is growing pretty quickly. I think it's growing at around 50% year over year right now. My next position is Cloudflare, and the stock symbol for that is NET. I've made a couple videos on Cloudflare, but right now my market value invested in them is just over $34,000 from a cost basis of $21.9 thousand. So this stock has increased about the same amount as Datadog. It's made me $12,000.2 roughly. Cloudflare is actually one of my favorite companies, and their goal is to essentially make the internet run better. They started out by hosting websites, and then they realized that they could offer firewalls for those same websites. They could start optimizing the traffic to those websites, and now they've expanded into other areas as well, such as offering cloud computing. This company is also growing extremely quickly. Their leadership is really good at communicating, so I highly recommend, if you're interested in this company, just go read some of the blogs that their CEO puts out. The next largest position I hold is Snowflake, and this is a relatively newer addition to my portfolio. In fact, the last time I did a portfolio review, I don't think I actually held this stock. I have $13,500 invested in this company, so a pretty big drop off from the larger three positions, and that's actually a decrease from the amount I invested in it. So far I've lost about $1.3 thousand on this stock. One of the reasons for that is probably because Snowflake is the highest valued company on this list in terms of their price to sales ratio, and we'll look at those relative valuations a little bit later in the video, but Snowflake has always been a very expensive stock, and there's a reason for that. They're growing at something like 150% year over year, and they're also a data play the same way that Datadog is. What Snowflake does is it makes it so that companies can use them as their data platform in the cloud. Rather than building out custom databases, building out their own analytics and all these different functions, they can just offload all of that onto Snowflake, which scales at the same rate as the cloud does. Now, Snowflake, I am extremely bullish on the company itself. I think they're going to do incredibly well. The only reason this stock isn't in my top 3 is because it's so expensive, and we'll see that again later in the video. My next position is Docusign. Docusign is just under $13,000 in my portfolio, and overall it's basically flat since I've owned it. It's made about $240. Docusign is essentially the leader in the e-signature space, and during 2020 they saw a big uptick in business as companies decided to sign documents virtually rather than going and signing documents in person. The thing I like about Docusign is even though it's a no-brainer that they would get an increase in traffic when people are stuck working from home and working remotely, they're not seeing a decrease in traffic as people are moving back to the office. This means that the e-signature product is more than just a work from home play. It actually saves companies money overall. The real struggle that Docusign is going to see is that they're a victim of their own success. Their e-signature product is so successful that eventually they're going to completely saturate the market. At that point, they're going to have to launch new products in order to keep growing at the rate that they have been growing. And while I think that they may be able to do that, that's not 100% certain. I made a whole video talking just about that. My next largest position is Upstart. And again, this is a new position and it's even smaller than the last 3. Upstart is just under a $6,000 position for me off of an initial investment of about $5,000. So I've made about $1,000 in this stock. What Upstart does is it uses AI to better evaluate risk. Now let's say you want to get a loan from a company. How do they tell whether or not you're qualified for that loan? Well, they might look at your credit score, they might look at how much money you make, they might look at some external factors like whether or not you've ever been evicted. They have some kind of algorithm that they built that they think tells you whether or not you're going to pay back the loan. But once you start to introduce AI into the mix, you can make these algorithms so much better than one manually created by people. This means that a company who uses Upstart's technology can find more leads who will actually meet their criteria, making them money, and customers who are placed using Upstart might be able to qualify for loans that they wouldn't have otherwise. This is a small position for me because I haven't done an incredibly deep dive into this company. I may actually make a video covering it probably in the next several weeks. But from a macroeconomics perspective, this stock makes a lot of sense, and so far it's done okay. So after this, we get to some of my smaller positions, including OKTA. OKTA right now is just under a $4,000 position for me, and in total it's made me about $200 according to Charles Schwab. Now OKTA used to be a pretty large position for me, which you would know if you watched any of my previous portfolio videos, but I've been trimming it slowly over the course of the year. What OKTA does is it essentially provides identity access management. Think single sign-on. Organizations can use OKTA and you can automatically sign in to all the different apps without having to enter your password every single time. They do all this as a service, so companies don't have to build it themselves. This is obviously a great benefit to companies, but the problem I see with OKTA is they might not have that many new ways to grow once they start to saturate the market. They've already been competing this entire time with companies like Microsoft with Azure Active Directory, but now even companies like Amazon with AWS and Google are starting to get into this same space, so the competition's getting a little bit more fierce. So far, OKTA has shown that they can compete on this same level, but because that competition even exists, while with companies like CrowdStrike there really is no competition, this is a slightly lower conviction position for me. After OKTA, we have C Limited, which is a new stock position since I last made this. I made a whole video talking about C Limited, and right now it's just under a $3,000 position for me after a $2,500 investment. So this stock's made me about $500. If you're really bullish on the stock, the way I might describe C Limited is the next Amazon, or the Amazon of Southeast Asia. They have their hands in tons of different businesses around the region. They started out as a video game company, and they actually run Garena Free Fire, which is the largest mobile game in the world. Then they moved over to Shopee, which is an e-commerce business, and it's the largest e-commerce business in Southeast Asia, and it's pretty big in Brazil. Even more recently, they moved over into C Money, which is a financial services company. So similar to Amazon, they're slowly expanding their scope of businesses. Of all the companies on this list, this company probably has the potential to become the largest, but at the same time, e-commerce is a hard area to compete in, so this isn't as high conviction as some of these other companies. That being said, there is a good chance that I increase the size of this position in the future if C continues to perform well. And then finally, the last position here, which I kind of already was showing you, is ZoomInfo. ZoomInfo allows you to get sales information and information on individuals from companies. So let's say I'm a salesperson who wants to introduce my product as a company and I have no idea where to start. Well, ZoomInfo can help me find that information quickly and easily and potentially lower those barriers. Now, this is a very small position for me. It's just $2,500. And in total, it's lost about $280 since I first bought it. And then if I scroll down a little bit more, you can also see that I currently hold around $6.8 thousand in cash. This is because I recently sold out of Zoom, which is a company that I've made a ton of videos on in the past. So let's talk about some of the changes that I've made in my portfolio recently and some of the changes I might be planning to make. So I could walk through all that in Charles Schwab, but I actually usually track my stock transactions in a separate Excel sheet, so I'm going to pull that up instead. So this Excel sheet right here is basically what I use to track my stock transactions over the course of the year, but all we really need to focus on are these last couple rows here, so basically April and May. In May, I sold $6.6 thousand for my Zoom position. This is in addition to the $15,000 of Zoom that I sold back in February, taking me from a $20,000 position at the beginning of the year to zero today. Also in the last couple months, you can see these two sales here of around $5,000 and $2,500. Those both came from OKTA. So OKTA was originally an almost $13,000 position, and you can see now it's a much smaller position from that. Finally, you can also see these three buys right here. These are just the three new companies that I've recently added to my portfolio. Those are Upstart, ZoomInfo, and C Limited. So this brings the total number of stocks in my portfolio to 9 at this point. Now, the last thing that I want to talk about is the relative valuation of some of these companies, because I've seen some comments complaining that some of the companies I'm investing in are way too expensive, and there is some validity to that. So I have pulled up here a list of all the different price to sales ratios of the different companies I invest in. So you can see that these range all the way from 23.2 for C Limited to as high as 91 for Snowflake. And you could look at those numbers and say that, well, C Limited is obviously way cheaper than Snowflake, but it's a little bit more complicated than that. First of all, C Limited has a huge amount of their revenue coming from e-commerce, which has margins of essentially $0. Versus a lot of these software companies can have margins as high as 70, 80, or even 90%. So if C Limited earns $1, they make maybe 1 cent off of that dollar in terms of profits. while these other companies might make $1 and they might keep 90 cents of that as profit. The other thing to focus on is, let's take a company like Snowflake, which has a PS ratio of 91. Snowflake is growing at 150% year over year. Let's compare this to, say, Datadog, which has a PS ratio of 41.47. Datadog is growing around 50% per year. So what would their price to sales ratios be next year, assuming they kept growing at their same rate and the stock price didn't change? Well, Datadog would be 30% cheaper. It'd be 41.47 divided by 1.5. So let's see what that would give us. 41.47 divided by 1.5. That gives us a price to sales ratio of 27.6 in a year from now. Now let's look at the same thing for Snowflake. Snowflake has a PS of 91. Let's divide that by 2.5. A year from now, their price to sales ratio would drop all the way to 36. What if we did that for another year? So we divide by 2.5 again. Well, 2 years from now, assuming Snowflake kept growing at 150%, their price to sales ratio would drop all the way down to 14.5. If we do the same thing with Datadog once again, their price to sales ratio would only drop down to 18. Now, obviously, it's not realistic to assume that these companies will grow at the same rate for 2 years consistently, but this is just an example to show that even though one company might have a really high price to sales ratio, if they're growing fast enough and if they have high enough margins, it can still be a reasonable value. The real question is, how long will these companies keep on growing? And if you can figure that out, you can probably pick stocks that'll outperform the market. But let me know what you think of these types of videos. They usually don't get quite as many views as some of my other videos, but I got a comment asking me to make another one, so I figured I would do that. Now, in addition to these brokerage accounts, I also own accounts on Robinhood, M1 Finance, and WeBull. And of those 3 platforms, WeBull is going to give you the highest sign-up bonus if you sign up using a referral link. So right now, if you sign up for WeBull, you'll get 1 free stock, and then if you deposit $100, you'll get an additional stock, and those 2 stocks together could be valued all the way up to $1,600. And I'll leave a referral link in the description if you want to check that out. Don't forget to like and subscribe, and I'll see you next time.